Okay, let's dive right into this. Before we begin today's explainer, please listen to the following mandatory disclaimer.
The content presented in this podcast is intended solely for general, informational, and educational purposes. Nothing herein constitutes or should be construed as financial, investment, legal, or tax advice. You should not act or rely on any information in this podcast without seeking the advice of a qualified financial professional. This audio/video podcast is an AI-generated product produced using Notebook LM. It automatically summarizes and synthesizes reports, analyses, and commentary originally published at reflectionsofreality.substack.com. All views, opinions, and analyses expressed are those of the original author and do not represent the views of any financial institution or regulator. Past performance is not indicative of future results. All investments involve risk, including possible loss of principal. All reflections of reality, all original content rights reserved. All right, with that out of the way, welcome to today's explainer of the Convergence Brief, published by Reflections of Reality. Today, we're literally going to see what happens when you take predictive market odds and smash them right into cold, hard institutional capital flows. It's fascinating.
Here is our roadmap for today. First, 2 lenses, 1 horizon. Second, lens 1, poly-market probabilities. Third, lens 2, weekly tape flow. Fourth, the convergence verdict. Fifth, the market rotation map. And finally, number 6, swing book tactical execution. Let's get moving. Section 1, 2 lenses, 1 horizon. So the foundational premise of this entire brief is that to really understand the market, looking at just one angle simply doesn't cut it. You need 2 entirely independent viewpoints. Our core methodology here is synthesis. On one side, we've got lens 1, which is the polymarket macro monitor. This is forward-looking, it's a probability-based engine driven by crowdsourced events. Then on the other side, we have lens 2, the weekly market intelligence brief, or just the weekly report. Now, this one is strictly measurement-based. It's a current cycle view that tracks the actual flow and breadth machinery of the market. Our job today is to synthesize these 2 by reading the polymarket odds directly against those weekly report flow metrics. Moving to Section 2, Lens 1, Polymarket Probabilities. Let's see what the crowdsourced engine is currently pricing in. The absolute standout number here is this massive 76.5% probability of a July Fed pause. The polymarket crowd is pricing in a totally rock-solid, higher-for-longer regime. And what's really wild is that this 76.5% represents an 8.5 percentage point dovish gap compared to legacy institutional expectations. Alongside this, the same crowd is pricing in an 89.5% probability of NVIDIA's continued AI dominance, and they are completely pricing in crypto capitulation. Basically, the crowd firmly believes the terminal rate is anchored, which they think effortlessly supports the massive equity multiples we're seeing right now. Now, looking at geopolitical tail risks, the crowd essentially expects continued Middle East brinksmanship over diplomacy. Look at these odds. Only a 4.5% chance of an Iran uranium deal by June 30th, and just a 7.5% chance of normalized Strait of Hormuz traffic. That means there's a persistent energy and safe haven premium baked right into the market. Meanwhile, the China-Taiwan situation, it sits at just a 6.3% probability. Really think about how crazy that is. The highest relevance tail risk out there, one capable of collapsing equities by 20 to 30%, is treated by the money as a massive, yet entirely dormant systemic threat. All right, Section 3, Lens 2, weekly tape flow. Now we're leaving the world of predictions and entering the strict reality of measured institutional capital flows. First up, we have to look at a proprietary metric called the Market Dashboard Indexed, or MDI. By definition, the MDI measures overall market sentiment. A reading between 10 and 35 puts us in the bullish mean reversion zone, but the 50 to 65 band is what we call the bullish kickoff zone. Historically, this is the absolute best risk-adjusted zone for swing traders as volatility begins to fall and the trend reasserts. This week, we are sitting exactly at 51.0. We are right in that bullish kickoff zone. Historically, that yields an average one-week return of about positive 0.71% with a 63% positive hit rate. However, a quick warning here, positioning flows have not yet confirmed this. Next, we absolutely must define the Market Valuation Index, or MVI. This is critical. The MVI measures how attractive stocks are versus bonds after adjusting for the business cycle. So it shows the cyclical equity risk premium, not raw valuation. High or positive readings mean stocks are cheap and rewarding relative to yields. On the flip side, deep negative readings mean stocks are expensive and risky relative to yields. And when we look at the actual MVI numbers this week, we see a classic risk-off signature hidden right inside a risk-on crown.
Large caps are slightly expensive, with SPY at negative 0.69 and QQQ at negative 0.61. But look at small caps. IWM is significantly lagging at deep negative 1.23. This is a very clear risk-off signal. The large caps are holding up the ceiling, but the broader participation underneath is absolutely flashing warning signs.
To navigate this kind of mixed tape, the protocol relies on the triple play. By definition, a triple play is a high-conviction alignment of three legs simultaneously. First, the bull percent, which is our positioning and flow trend indicator. Second, positioning, measured by the frontier, which is an options positioning oscillator measuring the position between the call and put frontier. And third, sentiment, measured by the CPR, or call-put ratio. Now, while this three-way institutional backbone actually remains confirmed right now, there's a serious underlying breadth crisis. Another proprietary metric, health, which measures market breadth based on a machine learning flow model where high means broad trend confirmation and low means divergence risk, is sitting at a very weak 40.9%. We're also seeing a clear defensive rotation in the flows and a subtle bearish option skew acting as a countersignal.
But here is the most glaring warning light in the tape: the accumulation reading. Now, accumulation specifically means institutional buying or inflow. Right now, it's sitting at just 9.6%. That is below the critical 10% threshold. It proves that actual institutional buying conviction is weak. The big players are simply not putting fresh capital to work at these levels. The capital inflows are entirely failing to match the macro narrative's bullish promise.
Which brings us to Section 4, the convergence verdict.
Narrative versus flow. What actually happens when we smash the forward-looking poly-market odds against the weekly report's hard flow machinery? This matrix reveals exactly where the two lenses align and where they completely fracture. On the Fed pause and rate path, both lenses agree. The crowd expects a pause, and the tape's MDI at 51.0 alongside a confirmed triple play backs up that bullish setup. But on equity regime quality, they completely disagree. Polymarket thinks the pause effortlessly supports all-time high multiples. The weekly report says no way, because that sub 10% accumulation reading reveals a massive conviction deficit. Basically, they agree on the direction, but wildly disagree on the internal strength needed to sustain it.
Let's look at how this plays out in Section 5, the market rotation map. To track capital flows, we rigorously define the 4 proprietary Barrow Protocol rotation states, and you need to understand these exactly. Accumulation means institutional buying and inflow. Rotation in means improving momentum and entering a bullish phase. Rotation out is fading momentum and profit-taking, and liquidation means institutional selling and outflow. It is so important to remember, these states are not some lagging echo of a news headline. They literally are the narrative being expressed in actual institutional capital flows. Look at this comparison. On one hand, we see pristine accumulation in assets like TSM, up 21.50 week over week. It's perfectly aligned with the tech bid. On the other hand, we see GE in rotation out, suffering despite global defense narratives. But the absolute ultimate convergence gap right now, it's in NVIDIA. Remember how the polymarket crowd gave NVIDIA an 89.5% dominance probability? Well, the actual tape flow is showing outright liquidation. Let that sink in. The narrative and the big money are moving in completely opposite directions.
Finally, Section 6, Swing Book, Tactical Execution. Given all this data, how does the model actually deploy capital? It's incredibly clinical. Capital is deployed strictly based on triple play alignments. Right now, SPY represents the highest confidence planned entry because its triple play is confirmed true. Over in the active Beacon 1 book, TSM and GE are being held as live litmus tests, governed by emotionless, strict trailing stops. But most tellingly, look at the MAGS_D book. It is sitting in 100% cash. Same with the KISS book, full cash. They are waiting for this glaring conviction deficit to resolve. Though if you're looking for the cleanest setups on the spectrum right now, names like UNP and CAT are showing the best internal health.
Which leaves us with the ultimate question as we wrap up today's explainer. Take a hard look at your own holdings. Are you trading the story that the probability markets and flashy headlines are telling you? Or are you actually positioned for the reality that institutional capital flows are revealing right under the surface? It's the difference between hoping for a narrative and trading the actual tape. Thanks for joining me to break down the Convergence Brief, and I'll catch you on the next explainer.